When I ask people what their retirement dreams are, the answers tend to be simple. Most of us just want to have enough saved to live a comfortable life doing more of the things that we enjoy. But for many of us, particularly women who take significant time out of our careers to care for others, etc., the idea of living a comfortable retirement can seem more like a stretch target than a certainty. So this is why if I were to hand you a crystal ball right now to help you make a decision about where to invest your super, my guess is that you'll generally ask a question like this. Well, which fund will have the highest returns and grow my money the most? Perhaps you'd ask, which fund that invests ethically or in line with my values will have the highest returns between now and when I retire. But of course, sadly, none of us have a crystal ball. So when it comes to making a decision about choosing a super fund, or any investment fund for that matter, we need to know what we should be considering with the information we have available now to make a good decision about the potential performance of a fund in the future. So as always, the information we share is general guidance only. It's not tailored to your personal situation. So we recommend you seeking professional advice from a financial advisor before making any financial decisions. And in fact, when it comes to financial information and resources, we encourage you to interrogate anything and everything you read and come to your own conclusions always. So building your knowledge and gathering information like this is an important part of this, because small differences in the average performance of a fund could add up to hundreds of thousands of dollars difference in retirement outcomes later in life. And it's not overly complex to make a sensible decision around how a fund may perform. But unfortunately, most of us have never been taught a framework for evaluating potential performance. And this is why the Banking Royal Commission found that many Australians are invested in poor performing super funds, charging excessively high fees. And it's why there's now such a strong focus on educating people around investment fees. There's even a school of thought that simply choosing a fund with the lowest fees is likely to lead to the best performance. Internationally renowned investor Warren Buffett has famously instructed in his estate plans that when he passes away, he wants the bulk of his money left in trust to be in low-cost index funds. And in Australia, the Barefoot Investor sold millions of books showing everyday Australians how they can save money by paying lower fees on everything from home loans to investment products. But are fees really the golden panacea when it comes to making a decision about the future performance of a fund? Well, the answer is yes and no. I should premise the rest of this article with the disclaimer that I'm a co-founder of a super fund that charges below average fees for a balanced product. But despite our commitment to keeping our fees low, we've never been focused on offering the lowest fee product on the market as the best strategy for driving returns to our members. My view on why it's problematic to focus solely on fees to evaluate the potential performance of any form of investment fund is that it's a shortcut designed to get people out of the worst performing funds, but it's not necessarily a good one for choosing the best performing funds. And I certainly think that the average Australian is smart enough to be given a more sophisticated framework to work with. So, what the data shows about fees and performance. There's certainly a strong correlation between the worst performing super funds and the high fees they charge. For instance, a 2019 report by StockSpot showed that the 10 worst performing funds charge their average members over 2% in fees, well above the average fees charged by the best performing funds. So in the supporting article in the comments below, we break down and illustrate some of this data behind this, which is fascinating and worth a read. But essentially, choosing the cheapest fund available may prevent you from getting ripped off, but it's unlikely to answer that question you ask the crystal ball, which fund will perform best? And it's certainly unlikely to answer the question of which fund will perform best based on your specific needs and risk profile. And of course, that's because there's a number of reasons that fees vary between funds. This includes that it typically costs more to have money invested in higher growth assets, such as shares, compared to having money invested in more conservative investments, such as cash. So funds often, but not always, charge a higher fee for options with more growth-focused investments. So how do we evaluate which funds are likely to perform best? To answer this question, I'm going to quote the sensible and unbiased advice on the Australian Government's Money Smart website. They say, compare your fund's investment performance over at least 5 years. Consider the impacts of fees and tax. Compare like with like. This is an important element that we will explore more in this video. For example, only compare a balanced option with another balanced option, and of course try to use the same time period. So I'll break this down for you to show you how you can use this guidance to make an informed investment decision. So let's start with the last part of this guidance and talk about risk and returns and why we need to compare like to like products. So understanding risk versus performance, or risk and return. So when looking at performance, it's important to consider the risk profile of your investment. That's because funds that typically target higher returns often carry higher risk in years where the market performs poorly. So investment options, in order of how much they're invested in growth assets, can typically be categorized in these broad categories. So you have your growth funds. So they might have an investment mix of around 85% in shares or property and 15% in fixed interest or cash, or maybe 100% in shares or property for a higher growth option. And in terms of returns, they aim for higher than average returns over the long term. But of course, with higher returns comes with higher risks. So there's higher risk of losses in the bad years than would generally be experienced with lower risk options. Then you've got your balanced funds. So they might have an investment mix of around, say, 70% in shares of property and 30% in fixed interest, or 50% in shares and property for a more moderate option. So they aim for reasonable returns over the long term, but with less risk of losses in bad years, or maybe those losses occur less frequently than in the growth option. And then you've got the conservative funds. So their investment mix might be made up of 30% in shares and property, so 30% in those growth assets, and 70% in the fixed interest and cash. And of course, they're aiming to reduce the risk of loss, and therefore they accept a lower return over the long term. But of course, there's less chance of having a bad year than in the growth and balanced options. And then there's cash, which may be made up of 100% deposits with Australian deposit-taking institutions, or in a capital guaranteed life insurance policy, and they aim to just guarantee your capital. So here's the tricky part. You can't always rely on the name of the fund's investment option to determine if it truly fits into the categories above. So this is important, and I'll give you an example why. So imagine if there were two funds with the name balanced in the title. We'll call them option A, which has a, let's say, 50% invested in growth assets like shares or property, and option B is 80% invested in the growth assets. So in years when the market conditions are good, option B is likely to outperform option A, but in years where the market turns downwards, option A is likely to outperform B. Over the long term, it's likely that option B, the one with 80% growth assets, will outperform option A, but it also carries more risk with it because option B has, more money invested in the growth investments. And so this, even though they might have both have balanced in their title, the differences in their investment mix may impact your considerations around comparing fees between the two funds. So the lesson here, as always, is to check the information available on the super fund's website or read the PDS or product disclosure statement to understand the true investment mix of each of the available options. So similarly, you may also be interested in ethical options. And again, here it is important to consider this like-for-like products, as there's no specification around what is and isn't considered responsible or ethical or green. So make certain, again, you dive in and understand exactly where your money is invested if this is important to you. You can read more about choosing the right investment option on the government's Money Smart website as well. So once you know what investment mix or option is right for you, and you understand how to find and compare these like-for-like products, then it's time to check out how they're performing. So there are a few ways that you can compare the performance of various funds once you've selected some of these like-for-like options. So you can take a look at each fund's PDS, which will list the target return. So that's the return that they're aiming for each investment option. You can then compare the target return with how these options have performed over the past 1, 3, 5 year time horizons. So this information should be reported by your super fund as the net return after the variable fees and taxes have been taken out. And you'll usually find this information on the fund's website as well as in your statement. So again, it's just incredibly important to make sure you're comparing these like-for-like options. And then let's understand how fees fit into this mix. So let's take a look at the fees that the fund's charging and ask yourself if those fees appear reasonable and justified based on two things. One, the performance of the fund, and two, other services the fund may provide. If you're in a super fund that's charging higher fees than comparable like-for-like options and performing worse, then fees may be something you want to seriously consider. So finally, a note on ethics and performance. So ethical funds are one type of fund that tend to demonstrate that lower fees don't necessarily equal higher returns. There's typically a cost associated with investing ethically, as undertaking the screening of the ethical companies comes with an additional cost. However, the average ethical investment option, when they're actually well-screened ethical products, not just ethical by name, are generally outperforming the market over the short, medium, and long term. And there's a lot of research behind this, and we'll include some of this in the supporting documents to this video. So a final note on choosing the right super fund. So just remember There are other considerations outside of performance to consider when choosing the right super fund or investment option for you. This may include ethical decisions around where your money is invested, as well as decisions around your risk profile and the type of insurances and other support services being offered by the fund. Taking the time to research and consider how a fund may perform will support most of us to make a sensible decision when it comes to building our retirement savings over the long term, whatever your dreams of retirement may be. See you next week.